Hello everyone, welcome back. If you're new here, welcome to our channel where we will be talking about all things money, business, and investing. Today's video is going to be an interesting one because we will be discussing 6 lessons from a book called One Up on Wall Street by Peter Lynch. Peter Lynch is widely regarded as one of the best investors ever, with an astounding track record that will blow your mind. In 24 years at the helm of the Magellan Fund, he averaged a 29% annual return, turning an initial investment of $10,000 into more than $28 million. It was the longest and most successful period of sustained performance in the history of mutual fund management. And during his tenure, the fund's assets under management grew from $18 million to over $14 billion. The insights shared in this book are timeless and hold immense value even today. So if you want to level up your financial literacy, join us and explore the key takeaways from this book in the next 10 minutes. Lesson 1. Invest in what you know and understand. Peter Lynch emphasizes that it is crucial to invest in companies that you comprehend, aligning this principle with your own life experiences. He asserts that investing in unfamiliar domains can lead to pitfalls and questions like, how can I possibly evaluate a semiconductor company when I don't know anything about semiconductors? Or, what does X Corp do anyway? These queries arise because many investors blindly follow hot stocks or invest in sectors they barely understand, hoping for substantial returns. However, Lynch advocates for focusing on companies you know well, stating, "It is far better to be a one-legged duck than a two-legged goose." By investing in areas close to your expertise, you can significantly reduce the chances of making poor decisions and increase your likelihood of finding hidden gems that others have overlooked. Lesson 2. Don't be afraid to lose money. In the realm of investing, losses are inevitable, but one must learn to adapt to them and move forward. Peter Lynch explains that while nobody enjoys losing money, it is essential to understand that every important invention throughout history has experienced periods of ridicule and failure. For instance, the first version of the airplane crashed, as did the second, third, and several subsequent attempts. Yet this setback didn't deter inventors from continuing to refine and improve upon their concept. Similarly, when it comes to investing, there are bound to be losers along the way, but it should not discourage you from trying again and learning from past mistakes. Instead, you should see losses as a natural part of the process and focus on making sound investment decisions going forward. Lesson number 3, diversification is important, but it's not everything. According to Peter Lynch, diversification is crucial, but it shouldn't be overemphasized to the point of paralysis. He argues that investing solely in low-risk options such as bonds or large-cap stocks may seem appealing, but it can lead to mediocre returns and missed opportunities. On the other hand, excessively concentrating on high-risk ventures with the hope of generating massive profits can be equally detrimental. The optimal approach involves striking a balance between risk and reward by diversifying across various sectors and asset classes. Lynch suggests that instead of blindly following the herd or relying on gut feelings, investors should conduct thorough research on individual stocks before making any investment decisions. While diversification is essential, it should not overshadow the importance of fundamental analysis and due diligence. 4. Let your winners run while cutting your losers. Peter Lynch highlights the significance of allowing winning investments to grow while simultaneously trimming losers to limit potential losses. He emphasizes that constantly monitoring and adjusting one's portfolio based on short-term market fluctuations can be detrimental to long-term success. Instead, Lynch recommends that investors should focus on conducting thorough research before making any investment and then exercise patience, letting their investments run their course. This approach enables investors to ride out market volatility and potentially benefit from long-term growth without being unduly influenced by short-term price movements. Striking a balance between active management and a buy-and-hold strategy is key to implementing this approach effectively. Lesson number 5. Do your homework on a company before buying its stock. Peter Lynch strongly advocates for conducting comprehensive research and due diligence before investing in any company. He emphasizes the importance of understanding a company's products, services, competition, and future prospects, rather than relying on hype or market sentiment. Lynch suggests that investors should study a company's financial statements, including its balance sheet, income statement, and cash flow statement, to assess its financial health and growth potential. Additionally, it is crucial to consider qualitative factors such as management quality, competitive advantages, and industry dynamics. By thoroughly researching a company and understanding its underlying fundamentals, investors can make more informed decisions and avoid potential pitfalls. It is also essential to stay updated on market trends and economic conditions, as they can significantly impact a company's performance and valuation. By conducting thorough homework, investors can position themselves for long-term success in the market. Lesson number 6. Think long-term. Peter Lynch encourages investors to adopt a long-term perspective when making investment decisions. He emphasizes that short-term market fluctuations are normal and should not dictate investment strategies. Instead, investors should focus on identifying companies with strong fundamentals and growth potential and holding on to them for the long term. Lynch highlights that market volatility can create opportunities to buy good stocks at lower prices, and investors should be prepared to take advantage of such situations. He also stresses the importance of staying invested in the market, even when it's performing poorly, as this allows investors to participate in the eventual recovery and growth. Lynch emphasizes that a long-term perspective enables investors to ride out market cycles and potentially benefit from long-term growth trends. He also highlights that a long-term focus helps investors avoid emotional decision-making and stick to a well-thought-out investment plan. To cultivate a long-term mindset, investors should set realistic expectations, diversify their portfolios, and regularly rebalance their investments. Thank you for watching this video. We hope you found these lessons from One Up on Wall Street by Peter Lynch insightful. Remember that investing involves risks, and it's essential to conduct thorough research and consider seeking advice from a qualified financial advisor before making any investment decisions. If you enjoyed this video, please give it a thumbs up and share it with your friends. As always, until next time, keep investing wisely and let compound interest work its magic. Happy investing.